Bitcoin is the first engineered monetary system in the history of the human race. Full stop. If you had $1 million in the bank 12 months ago, today it buys you 34% less, right? The S&P is up 34%. You have $1 million. If you put it in the stock market, you've got $1.34 million. If you hold it in cash, you've got $1 million. If you go to buy a stock now, it costs you 34% more to buy the stock. If you go to buy a house in the Hamptons, it's 40% more to buy the house in the Hamptons. Now, if we look at the modern era, economists like Saifedean Ammous, who wrote the Bitcoin Standard, he estimates that the inflation rate in the modern era, dollar weighted, is 14%. Okay? Think about that. For the last decade, on average, all in the world, we've been inflating the currency by 14% per year. Now, it happens that that's equal to the rate at which the S&P 500 index is going up, 14% on average a year for 10 years running. What's the issue? Well, what is inflation? It's not really well understood. Some people think it's CPI. CPI is the rate at which a market basket of consumer goods is going up, but the government gets to pick the basket.
I've noticed.
Okay, if I pick things like Domino's Pizza and streaming YouTube videos, they will never go up in price. I can actually adjust the basket, so I just pick things that don't go up in price. The Case-Shiller index is up 27% year over year, in July. So the price of that average single-family home is up 27%. Homes in Canada up 15%. The S&P index is up 34% this year over 12 months. What's the inflation rate? If you wanted to buy a basket of desirable stocks, the inflation rate is the S&P index. So I can calculate any inflation rate I want. Inflation is a vector. If I want to be rich, then I need to buy scarce, desirable assets. So my inflation rate is the rate at which Picasso's and Leonardo da Vinci paintings and stocks and property in New York City is going up in price, or a house in the Hamptons. That's a high inflation rate. If I want to be a consumer and live in my parents' basement and order Domino's Pizza and take Ubers and watch Netflix and stream YouTube, the inflation rate will be the CPI. It'll be very low. So you can have any inflation rate you want. As a practical matter, the best inflation rate for an investor or for anybody that wants to stay wealthy or be wealthy, if you're concerned about maintaining your economic purchasing power, it's the monetary inflation rate, the rate at which the supply of money is expanding. The supply of money expanded maybe 10% for a decade before COVID, and the S&P went up 10% a year. We know the money supply expanded 30% post-COVID. The S&P is up 34%. The Fed stepped on the money printer. The same with the EU Central Bank. In the Western world, in the strongest countries, we see the money supply expanding 20, 25% or more per year. The currency is collapsing. It's losing its value. It's being devalued. In weaker countries, go to Argentina, the official inflation rate's 45%, the unofficial inflation rate's 85%. Go to Venezuela, the inflation rate, the currency's collapsed 98%, 99% in a year. Same in Lebanon, 90% currency collapse in a year. So what you have right now going on in the world is currency collapse, which we call inflation. And the mainstream view of inflation is it's only CPI, and sometimes it's PCE. It's an index of things not including the highly volatile food and energy.
Right.
But in what universe can you live without food and energy?
Exactly.
But it's not really good. Like, common sense says, if everybody tells me inflation rate's 2% or 5%, but the houses are costing 20% more or 15% more, and everything, if you talk to anybody that manufactures anything, they'll say that the prices are up 20%, 25% year over year. So how is it I'm supposed to actually buy something? How do you buy a share of stock that went up 34% a year when you got a CPI adjustment of 2% or 5%?
So it sounds like the people causing the inflation are lying about the inflation.
Classically, if you define inflation as the CPI, you're using simple arithmetic to describe the economy. you can't describe the economy and model it with simple arithmetic any more than you could describe fluid dynamics or aerodynamics with simple arithmetic, right? The fluid is flowing around the airfoil. You have to have in-dimensional, algebra and vector calculus to describe a complicated phenomena. The economy is a complicated phenomena. Another way to say it is the price of everything is varying everywhere at different rates all the time.
Right.
Common sense says the price of housing in the Hamptons is going up at a different rate than the price of land in Kansas, and the price will be going. And the price in a certain jurisdiction for a certain use, subject to certain regulations, will go up at a different rate than another jurisdiction for another use. So, the problem is inflation. Inflation's a phenomena whereby a government authority prints more currency. Right? And why do they print more currency? Because if I want to pay $1 trillion bill, I either have to tax you $1 trillion or I have to print $1 trillion of money. Turns out that it's a lot easier to print money than it is to tax people. And so it's either inflation or taxation. Throughout the history of the world, from Roman emperors before, every single coinage system, every monetary system ever established collapsed because of inflation. If you look at the history of the Sumerian states, the Persian states, the Greek states, the Roman states, Middle East, look at all the Renaissance Italian states, look at every king of England. If you just go forward, you find every one of these currencies started by I issue a coin with this much gold in it, and then I cut it, and I cut it, and then I go to silver, and then I go to copper, and then I coat it with some brass or some nickel. You remember what happened in the U.S. where we used to actually have silver
quarters,
and now we don't because the silver was more valuable than the quarter.
Yes.
Why? Right? We're debasing the currency, right? So the problem is inflation. How would you say this? If there's a certain amount of goods and services and capital in the economy and you just keep printing money, you're not creating any more capital in the economy. You're not creating any more products. You're not creating any more buildings. You're not creating any more services. All you're doing is doubling and tripling the amount of currency. So if I just gave everybody in the United States $1 billion and everybody went out to buy a Ferrari, right? Would there be 250 million Ferraris? Like, I can print the money, right? Like, look at Venezuela, look at Zimbabwe. They can print the money. You can give someone $1 trillion note. But that doesn't create more stuff, right? You're just creating paper. So ultimately, that inflation, it works only to an extent if you can export it. And what you're doing is you're not creating anything. What you're doing is you're redistributing wealth. Like if there's $10 billion in the economy and there's this much stuff and I give $1 billion to you, you now get 10% of the stuff from somebody else, which means that everybody else lost 10% of their stuff, right? As I inflate the economy, inflate the currency, I'm actually redistributing wealth from those that store their life savings in currency or currency derivatives, in cash. If you had $1 million in the bank 12 months ago, today it buys you 34% less, right? The S&P is up 34%. You have $1 million. If you put it in the stock market, you've got $1.34 million. If you hold it in cash, you've got $1 million. If you go to buy a stock now, it costs you 34% more to buy the stock. If you go to buy a house in the Hamptons, it's 40% more to buy the house in the Hamptons. If other things are going up in price, your cash is fixed. So it turns out that you've got some people that don't have net cash positions. If you're a sophisticated investor and you're wealthy, all of your assets are in property. You have buildings, you have companies, you have real estate, you have collectibles, you have sports franchises.
Right, you have things.
If you're middle class, working class, you're working for cash, and whatever cash you've got, right, is either sitting in the bank or you don't have a lot of net cash. So the real significance here is if the dollar loses 20% of its purchasing power each year, then the value of your salary is deteriorating by 20% a year. It's not falling at the rate of CPI inflation. It's falling at the rate of monetary inflation. The road to serfdom is working exponentially harder for a currency growing exponentially weaker. Okay? That's the problem.